Welcome to our 2024 webinar series. Throughout this series, we'll shine a light on three common client types that fee-only financial advisors often encounter. Follow the Green family as we illustrate the importance of lifetime insurance planning. Each webinar will last about 50 minutes, and you must be logged on for the full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them in the questions box. We'll answer all questions as best as we can. Today's webinar is being recorded and will be posted on our website within 24 hours. Today's presenter joined LLIS in 2003 and assumed the role of CEO in January of 2013. Here to talk on life insurance is Mark Maurer.
Hi everyone, this is Mark. Thank you all for tuning in. It's hard to believe that we're already halfway, or it feels like halfway through the year. My kids are starting to wind down on school a little bit. So glad that you all could tune in today. Glad you could be here. And so we're going to talk about the Green family a little introduction to them, and talk a little bit about trying to protect them, their families with life insurance, and some options that they have that will probably mirror what your clients may have when they come to you when you sign them on as a new client. And we're also going to try to predict the future a little bit. It's a hard thing, but it's part of what you all do every day. You're trying to predict the future of how much your clients have in assets and their ability to retire and their ability to not need long-term care, hopefully, but if they do, they have insurance for it. So all of those things that we're trying to predict and estimate what's going to happen in the future. So we try to do a little bit of that today too. So who are the Greens? Well, we have, if the click button works, there it goes. Harry, what? He's a financial planner. And Lauren, a stay-at-home parent. We also have Kevin, who's a cardiologist fellow, just finishing up in school, and Irene, she's a dentist already working. And then we have Sarah, who's an Amazon software engineer. And so we meet them all at age 35, and we follow them into the future. And remember big? No, I wish I were big. Guess you get to my age and you wish you were smaller, a little thinner. Maybe our hair was a little bit bigger. But so we're going to try to predict the future. Zoltan took him into the future, said, here's what it's like when you're big. So we're going to try to do a little future predicting ourselves. Harry, he's age 35. Remember, they're all 35 at this point. I don't know how that would work. I guess maybe they're all triplets, but go with it. Age 35, financial planner, making $200,000 a year. And we have Lauren. She's also age 35, a stay-at-home parent, and two kids, Lionel, age 4, and Lily, age 2. So that's them. That's probably not unsimilar to many clients that start talking to you as they come on board. I have a fairly good income. Now I have kids, a spouse to protect. I want to make sure that everything I do with my income is setting us up all well for being able to pay for college, pay down the mortgage, have a good retirement. Kevin, he's a cardiologist fellow, making $90,000 for now. He's still in the early stages. He hasn't launched, as I think the vernacular is, to where he starts making a lot more money. Working, still going to school, still doing all of these things, and making an okay salary, but that's not what the goal is or what he really expects to. And Irene, also age 35, dentist, making $150,000. She's already started making good income and will continue to have an income that grows. Sarah, age 35, Amazon software engineer, $150,000 income. Now she probably has some stock options and other things too, but all starting off fairly similar incomes. So again, their situations are different. Kids, no kids, single. So what all things do we do? Again, we're trying to predict the future with Zoltar. It is a pretty creepy looking picture though. So Harry, start off with Harry. What do we use life insurance for? Mostly we use it for income replacement. Here we have sort of a classic example. One spouse is the sole breadwinner, the other works at home with the kids. If Harry were to die tomorrow, the household income goes from $200,000 to zero. There's no second partner, second spouse, second income to keep things going. If Harry wasn't there tomorrow, all income stops. It doesn't get cut in half or in 2/3. It stops. So what we look at as a potential, or sort of my personal rule of thumb, is you should have about 10 times income as a minimum, as the picture shows, a floor, if you will. A floor. Yes, I know, sorry. So that's the floor. 10 million or 10 times earnings, $2 million. If Harry died tomorrow, they're not going to be in the same place as if Harry continues to work for the next 20 or 30 years. But it would prevent catastrophe. She may have to go back to work, but there'd be money to pay for childcare expenses. There would be money to pay the mortgage every month and to pay for groceries. It may not last them to age 90, 95, but it prevents catastrophe. It prevents them from having to sell the house right away, or some of these other things that we worry about as parents, as spouses, as people who are just part of the family. So what's the right number? Well, the floor, using my numbers, $2 million as a floor. Now, as an upper bound, insurance companies have income replacement guidelines. And this is one particular insurance company's. Under age 40, they'll consider someone really without any additional financial documentation, reasonings, up to 25 times income. Another book I have right here, I think, under age 30, up to 40 times income. 30 to 39, 35 times income. So this particular insurance company on this screen is maybe even a little on the cautious side. This other company I'm looking at, under age 40, can be 35 or 40 times income. So that's sort of our upper bound. So at age 35, maybe 25 times income would be a number. And so we're talking $5 million of life insurance. He's 35. If he works another 25 years, that's age 60. So there's sort of where that number comes in. I have a question. Do you recommend 10 times pre-tax or post-tax? In this scenario, I recommend 10 times pre-tax. So whatever somebody says, I make $200,000 a year. Again, we're going on a minimum. So my minimum also probably I wouldn't also shoot for 10 times of the net, of after tax, because now we really are getting to a pretty minimal. 10 times what somebody says their salary or income is just sort of my number. So I look at it as any numbers here where we're talking about salary or income replacement. Insurance companies look at it at gross numbers when doing some of these calculations, because that's readily available, easy to verify. Again, my number is 10 times salary, the pre-tax number, and then because potentially life insurance comes income tax free. So if he makes $200,000, that's not what he's taking home. But so 2 million tax free actually gets him more than, or would get her more than 10 years of what their net after tax number would be. But 10 times Nice round number. Good question. So now we have the 2 million in this particular case up to 5 million. Now, as I'm looking at some of these charts, could go 35 times 200,000. So even more than $5 million. But let's say for today, Mark's minimum 2 million, 10 times earnings, insurance company's maximum 25, so up to $5 million. So what's the right number? It's kind of like looking in a magic 8-ball. Luckily, you all have financial planning software that's going to take more inputs than what I might have or what I'm looking at here of just somebody's income. To say what other assets do they have, their financial planning, needs, goals, all those other things. So somewhere in there is a right number that you all are going to help or work on to refine down. But the number probably should be somewhere between 2 million and 5 million. But what's the right amount? Who knows? We do all of our best guessing, but there's no perfect number. There's no correct answer, of course. So you as a financial advisor came up with a $3.5 million need, which makes sense. It's between my lower bound and upper bound. Just split it in the middle, but that's a good number. Kind of like Goldilocks, not too hot, not too cold, not too hard, not too soft. Perfect. So right in the middle. And on this slide, the other thing we did is we looked at layering life insurance. So we defined the need for income replacement. What's the other thing that happens with income? We earn it as we go through life. So every year that I've earned, or in this case, Harry's earned $200,000, he's 1 year closer to retirement age. He has 1 year fewer, 1 year less income, 1 year fewer years of income. That's a hard grammatic one right there. But the more he works, the fewer years of income he has ahead of him. So in 10 years, he's earned $2 million pre-tax. So he's saved for some college. He's gotten the kids to driving age. He's getting closer to retirement. So with a life insurance term layer, if you can see here, the longer the term policy, the higher the premium per dollar of coverage. So if we just look purely at the last two, $1 million of 20-year term costs $520 a year. $1 million 30-year term costs $890 a year. Same life insurance, but it's covering him for an extra 10 years. The 20-year term covers him from age 35 to 55. Low expectancy of him passing away. A 30-year term covers him from 35 to 65. Now we've added 2 more years later in life, 55 to 65, where people, especially men, may start to have heart attacks, may start to have things that happen to them. So the longer we have that life insurance, the higher the premium. So in this scenario, if we take it to an extreme, in 29 years, the year before he's retired, he doesn't still need $3.5 million of life insurance, because 1 year of income that he has remaining is not $3.5 million. If it is, fantastic. He's doing something right. But for most of us, it's not going to be. So my need, Harry's need, most of our needs for life insurance are highest today, and we have the most years of income ahead of us. And then as time goes on, it drops off. So we look at layering policies. So for the first 15 years, he has that $3.5 million and gets the kids through driving age. Then after 15 years, that first policy drops off. Now he has $2 million. So 15 years, $3.5 million. After 15 years, that first policy dropped. Now he's got $2 million for 5 more years to get the kids out of college. Kids are out of college, He's got 10 years left of retirement, sort of that savings age, finishing off paying the mortgage, and he has $1 million for those last 5 or 10 years before retirement, because he's got 20 years of income, getting kids out of the house and college savings behind him. So the need is less, and the premiums drop off as time goes on too. So I love the term layering for this idea, this plan to save premiums not only at the beginning, but as time goes on and he gets closer and closer to having no income needed. Here's Lauren. So she had 0 income. Now, if you read as many insurance publications as I do, which I'm sure you don't, and I don't think anybody's ever said that they want to, this is one thing that insurance companies and sort of financial planning industry groups and everybody says is just kind of a worry, that there are so many spouses who, even though they don't have an actual income, don't have life insurance. But there's a big impact to the family system if Lauren's not there. And if you take this sort of with a little tongue in cheek, but if you have to, all the things that a stay-at-home parent does, which is actually a run around all the time parent, and I'm never home parent because I'm doing all these other things usually, you need, some of these are kind of silly, like a CEO, but there are some things that you may have to do, like daycare. Some expenses that if Lauren wasn't around, Harry might have to pay. He might have to pay for aftercare. He may have to pay for some other expenses so that he can work, things that Lauren wasn't doing. So there's not a loss of income, but there's some added expenses. So $118,000 a year is whatever is that one of those, what's a stay-at-home mom worth? But again, how do insurance companies look at it? For a non-working spouse, age 59 or less, they'll basically match the existing coverage on the employed spouse partner up to $1.5 million. So when Harry can qualify for up to $1.5 million, if Lauren wanted to apply for $1.5 million, then a lot of companies will say, we'll match that. We understand there's value there. Amounts over that considered on estate planning needs. So even a stay-at-home mom, dad, parent, in this case, as long as Joe or Trent or whoever, in this case Harry, has 1.5 million or more, the stay-at-home partner can be insured up to 1.5. If Harry only gets $1 million, then Lauren can get $1 million. Now again, using my kind of rules of thumb, 1.5 million should be fairly easy to get. $500,000, maybe $250,000, but $500,000 to care for kids for the next 10, 12, 14 years would probably be where I would start, sort of as just a minimum, $500,000. Oh, question. Would it be beneficial to renew a 15-year term every 5 years rather than having the layering strategy and keeping 3 policies in place? So a couple things to that. So when you have that low initial premium for that 15 years, you've locked in that client's age, health, and everything. At the end of 15 years, say it was a $3.5 million 15-year term policy. At the end of 15 years, the client has to go through all underwriting again. Financial probably shouldn't be an issue, but health, it could be. We get the life insurance now while somebody's younger and healthier and probably haven't had any of those health issues that come up later in life. So the wild card is, in 15 years, is Harry going to be insurable at that time? Is he still preferred? Maybe he's standard. Maybe he's had an episode of AFib or stroke. We don't know. So the reason that we lock all those things in place now is because we know exactly what the premium's going to be. We know exactly what it's going to look like, and we're locking in that good health today. If we do a 15-year and then see what happens then, that's the big wild card. If he's still in great health, then the rates would be based on someone 15 years older and still maybe preferred. So it may actually not be dollar-wise, it may not, the premium would be definitely more than what he's paying now for that 15-year term. So financially, it may not make sense, or maybe just be a break even, but health-wise is the big wild card that we don't know about, which is why we want to lock it in now when health is good and prevent him not being able to get coverage in 15 years potentially. All right, term policies. When we look at these term policies, there's a couple parts that go to it. So the policy fee, which is a fixed dollar amount, $75, $90 a year. Policy fee is going to be a large percentage of a small policy. This will make sense here in a minute or two, but when we go into a term policy, there's your fixed expenses and then your variable expenses. Your fixed expense is that policy fee. Your variable expenses are the amount of actual life insurance you have. And there's what's called bands. So it's kind of like buying you have your cost per thousand. So 500,000 may be like the normal size box of Cheerios. If you go up to the $1 million policy, that's like buying the big box of Cheerios at Sam's or Costco. You know, you get twice as many Cheerios, but it doesn't cost you twice as much as that middle-sized box. You know, maybe it's only 50% more. Then you have your $250,000 policies and under. That's a lower band. So that's like the little travel boxes of Cheerios that you get in the 8-pack that we used to take when we were kids when we went on vacation. Not a great deal per Cheerio. So you have your banding, you have your cost of insurance, that's your variable, and a flat fixed policy fee. So if we look at Lauren, we can layer coverage. So here we looked at $750,000 for her of 10 and 15 years. That 15-year layer gets the youngest to age 17. So if we looked at 2 standalone policies, each having that fixed policy fee, $142 and $168. One of the companies, just in this case happens to be Banner Life, they have term layers that if you layer term policies on top of each other, you only pay 1 policy fee. So the client only has 1 policy fee on that longest term layer. So in this policy, their policy fee is $90. So they pay it, she would pay it once on the 168, but not on that 10-year term layer. So it actually makes sense. A term layer for Lauren works pretty well too, because that policy fee is waived for shorter term periods. Question, clients see their incomes go up considerably as they age into their 40s and 50s. If we go with the layering strategy, how do we think about higher future incomes? Good question. So that's why many times the life insurance isn't necessarily an exact linear function. So it's not going to be exactly the same amount dropping off every time. So maybe, and that's part of where sort of the nuance of it comes in, and advisors you all can help with. Maybe it doesn't drop. You're more comfortable with it not dropping down to $1 million for 30 years. Maybe it stays at 2 million, and some of the shorter layers are less. But so when we factor in some of those numbers, it's all, again, we're guessing at the amount needed. If somebody's in a high income or high increasing income scenario, maybe don't do any layers. If that's a concern. But then, as I said, the year before they retire, 29 years from now, it's still a $3.5 million policy. So maybe there's some layering but maybe it doesn't drop as fast. Maybe it's instead of more in the short term and less in the long term, it's a little more graduated. That longer tranches, instead of $1 million, 1.5 or 2 million. So just sort of balancing. I think the timing usually works well for people. My kids are out of the house. College is usually done and paid for, and kids are kind of out of the, off the company wallet, hopefully. And then I have this last part to retirement. So usually those timings work. Just for Harry in that scenario, maybe there's more 30-year term and less of the shorter term, and those don't, those still drop off at the same time, but maybe those are smaller amounts. Good question. Okay, Kevin. He's that cardiologist fellow, not quite where he wants to be financially. It's going to be there soon. We just don't know exactly what it is, but what's his future income? It's not $90,000. He hasn't gone to school for most of his life to do that. Today it's $90,000, but cardiologists expect maybe $400,000 when they start. So when we start looking at life insurance for Kevin, what number are we protecting? What number are we planning for? If you're working with Kevin, 90,000 is sort of a placeholder number today. We're basing a lot of plans on that $400,000 that we're expecting Kevin to start making later this year, next year. The nice thing is, for many of these occupations, it's easy to find data of what physicians make. Insurance companies understand this too, that as a fellow, you pay your dues, you work a lot of years to make a lot more money later. And so the insurance companies understand that. And so there's special consideration on insurance, on amounts of life insurance for clients with special established occupations where income is expected to increase substantially. Fellow doctor fellows, this is sort of that number one. It will probably do it shortly, and it's very large jumps. So insurance companies understand that as well. 25 times of Kevin's current income is only $90,000, but that's not what we're planning for. 400,000 is what he's expecting in the next year or two. 25 times that is $10 million. So there's a big window. What's the right amount of coverage for Kevin? Well, what are we going to look at? Okay, they don't have any children and no plans for children right now. Irene, she has a good income already, making $150,000. With our first couple, there's only one income. Remember, income went from 200,000 to zero if something happened to Harry. In Kevin and Irene's income or household, right now, if Kevin died, actually he has the lower income at the moment. Irene's still making 150. So it's not as big of an impact now. In a year or two, when he passes away, it's going to have a large impact to the family unit. So things to consider, and you all work on this, and with your financial planning software. Home prices. What home did they buy? Rule of thumb says 3 to 5 times your annual income. So did they buy the house based on the $90,000 income? Did they buy the house based on the $400,000 income? There's a big difference in these houses, and there's a big difference in those mortgages. So Kevin, because Irene is working, makes a good income, and because they don't have any plans for kids, he may not need that 25 times income. At the same time, many of their expenses are probably based on that higher expected income. Right now, cover the mortgage plus some expenses for Irene. So a number to consider, 10 times, which is the lowest number, the $400,000, which is the highest number. See what I did there? We didn't only apply for 900,000, which is 10 times his current income. We don't expect that to kind of stay. So 10 times his expected income, $400,000, $4 million of coverage. That would allow him to pay off a $2 million mortgage and have 5 years salary replacement for Irene. Now remember, she's making good money herself. So to have a paid off house and an extra $2 million in the bank sets her up probably pretty well. And they're going to be Henry Dinks. High earners, not rich yet, and dual income, no kids. So they can sock money away. And they're working hard. They want to retire early. So maybe we don't need to look at 30-year term for them. They're in a position to say we want to work for 20 years. They can make $650,000 a year combined for 20 years. They probably can. So let's look at Kevin. Come back to him again. He's Standard Plus non-smoker. Says, yes, let's do the $4 million of coverage. That makes sense. Sets up Irene pretty well if something were to happen to me. And we're going to do another layer. $2 million of 10-year term and $2 million of 20-year term. So if something happens to him today, Irene gets $4 million. If he passes away in 11 years, she gets $2 million. But he should have had 10 years of around $400,000 a year in income, saved, paid down mortgage, and some of those things. So to the other question about clients that see their incomes go up substantially, if he's going to think he's going to start making a lot more than 400,000, maybe it's all 20-year term. And say if we can get to 20 years, then we're great. We don't need anything else. Or maybe it's $1 million 10-year term and $3 million of 20-year. So just some ideas. So what happens? So we talked about what if Kevin dies, leaving Irene. What if Irene dies? Well, Kevin's income might be sufficient. Single guy making $400,000 a year, probably be okay. Combined household, 650, no Irene, 400. Still better than most people. So he's going to be okay, but it's sound financial planning that if there's a loss of one income, we want to replace that. Because while it may not be the lion's share, I bet a lot of planning, the ability to retire in 20 years, the ability to have the house now and the house on the beach are all based on that $650,000 of income, not just 400. So all of those things that maybe they want to do, maybe he wants to do if she weren't there, still have life insurance on her. I could make the argument that at $400,000, if she were to pass away, he'd be okay. It's not a catastrophe. But sound financial planning says, let's have it there for her to help pay mortgage, debts. Just if something happened, he wouldn't have to make big decisions right away. And if something happened to her right now, he still isn't making that high income. But it's also emotional. Irene also contributes. She also has valued income to the family unit. So we don't probably as a emotional or client or relational issue, don't want to say your income isn't valued or your income isn't as valuable. While numerically it may not be as big of an impact if it was gone, it's just as valuable. A dollar is still a dollar. So we maybe don't need as much coverage on her as we do on him, purely because if one of those incomes wasn't there, it makes a much bigger difference. So for Irene, 10 times income, her current 150. We do a term layer, again, 10 and 20 years, $1.5 million. Half of it drops off after 10 when she has 10 years of income under her belt. And we can do that. However, and I mentioned this, sometimes those policy fees combinations don't work out. And we see here a little bit of buying the big box of Cheerios. For Irene, Banner wasn't an option based on some health issues. And so we needed to use a different insurance company who doesn't have that sort of term layering approach. So 2 standalone policies were going to be $784 a year. A single $1.5 million 20-year term policy was going to be $781. With the layer, we had to have the 2 policy factors, and we moved from that $1 million and above cost per Cheerio to a lower, or actually to a higher cost per Cheerio by going under $1 million. So for Irene, dollar-wise, it made sense to consider just a single $1.5 million 20-year term policy. When she, again, sort of to the question, I'm going to keep coming back to you because it's a good one. If maybe they need to work longer than 20 years, or we don't want to have the coverage drop off that much, she'll be paying $781 every year for 20 years. If we did the 2 layers, she's paying $784 for the first 10, but then only $477 for the second 10. So she ends up paying a little bit less initially for the first 10 years by $3, but then more those second 10 years for keeping the $1.5 million all 20 years. Yes, policy fees, cost per house. Check. Talking about another way. Big Harry Potter fan over here. We haven't watched the movies all the way through in a little while. By the way, Prisoner of Azkaban, best movie. And so this is Professor Trelawney, who's gazing into the future, and she also is trying to tell future. So here we have Sarah. Sarah is sort of another one. We don't know what Sarah's income is going to be, or her outlook in life is going to be. As of today, she has a good income, no dependents, no spouse or partner. That's today. We don't know what might happen in the future, but as of the moment, no one has a financial loss at her death. When we have our first couple and there's kids involved, if there's no income and it goes from 200 to 0, there's a stay-at-home parent and 2 kids who are relying on that income. When we have our other couple, Irene making 150 and Kevin hopefully about to make 400, they're probably making decisions based on that combined income. It's a big loss if he dies and they just bought that nice big house. Sarah, assuming she's living within her means and her income, which she should because she's the only one, if she were to die, and we'll talk about disability later and how disability, or not later, not today, but in the future, how disability is much more important for her, probably as important for Sarah as it is for Harry at the very beginning when there's only one income. Disability, much more important for her. Life insurance, not really a need. No one has a financial loss at her death. So there's almost no reason for her to have life insurance at this moment. Can't predict the future, things that will happen, but at least today, that's true. Now, fortunately for my example here, but unfortunately for her, she was sold whole life insurance 15 years ago. Yes, her first job, instead of having money go into a 401k or the IRA, any of that, she was convinced to buy some whole life insurance. Yep, it slices, it dices at Julianne's. So it was a place for her to save for retirement. So she put in a lump sum of some savings she'd accumulated and was paying $4,500 per year for the last 15 years. And her income was pretty good back then. So on an income adjusted basis, she was able to qualify for $1.3 million of death benefit. Here's where sometimes I get unhappy with insurance companies. Just because you can doesn't mean you should. Those income guidelines we showed, 25, 35 times income, then you could get $1.3 million of life insurance based on income replacement. But why should you? What's that? No one has a loss at her death. There was nobody in the picture. So just because you can doesn't mean you should. Feels like that's something I tell to my kids a lot. So today she's got a little over $1.3 million whole life policy, $300,000 of cash. I mean, she socked it away. You know, there was a pretty decent lump sum, and she's continued to pay for 15 years. Don't we all wish we were 35 with $300,000 of cash value in something? Still paying that $4,500, cost basis of $169. So if she were just to surrender it, she has a taxable gain of $137,000. Most of us don't want to do something while we have income coming in that creates another $137,000 of taxable gains taxed as ordinary income. So most of us are going to look to ways, what are things we can do that don't make that happen? Well, first, we look at her dividends. What's her dividend schedule been? So dividends are the earnings are basically unused premiums that insurance companies' whole life policies pay back to policyholders. So they collect the premium and return a dividend, which is whatever they didn't need because interest rates were higher than some minimum assumptions that they used for that in determining the premium, and probably people didn't die near as quickly as they thought they might. So dividend is a return of unused premium, kind of like your tax refund is a return of overpayment of taxes. I didn't get money back, really, I got back what I overpaid. So that's what a dividend is. In 2021, her dividend was $4,500. Oh, sorry. 2021, her premium was $4,500. She had a dividend of $3,100, so she paid $1,400 out of pocket. In 2022, her premium was still $4,500, but her dividend really dropped. It was only $1,700, so her out-of-pocket premium was $2,800. So her question, really, looking at this, was, I thought pretty much at this point I'd been told that that dividend was going to be more than $4,500. How it was pitched to me was that I put all this money up front, it's going to build cash value, earn these dividends, so that later on it's going to be more than my premium, so I don't have to pay any more premiums. It's just going to, you can't see my air quotes, but pay for itself. And it got kind of close there, but something happened, and whether crediting is basically crediting less interest and lower dividends. So her premiums are going the opposite way of what she thought it would be. She thought they'd be gone by now. And instead of decreasing, they're actually increasing. So what are her questions were, what are some options? Well, we keep on keeping on. Pay premiums, hope for higher dividends, hope for lower premiums in the future. Just kind of cross our fingers and just hope everything's going to be hunky-dory. But at the end of the day, there are still insurance expenses on this. So she's still paying for about $1 million of death benefit. Why do I say $1 million? She has $300,000 of cash value, a $1.3 million death benefit. So if she dies, the insurance company gives somebody $1.3 million, 300 of that is kind of her own money. But why is she paying for any of it? That's the question. She can cancel the policy. Second option, goes out and out, surrender it. She'll get $306,000. $169,000 of that will be tax-free, and she'll owe ordinary income on an extra $137,000 this year, this tax year. I don't know how many brackets that bumps her into. It might bump her into one new or maybe a second. Not great. So in a perfect world, we don't want to do that, but she doesn't want to keep paying premiums. How about option number 3? Reduced paid up. So sort of as the name implies, we're going to keep the existing policy, but just reduce it. So it reduces the death benefit to from $1.3 million to some amount that her current cash values would keep in force without premiums. So it's a reduced, smaller death benefit, paid up, no future premiums, not based on dividends. Also, no taxable event. It's going to be fairly conservative as an investment because whole life insurance companies must keep most of their assets that back their future liabilities in investment grade debt and guarantee instruments. So can't have hardly any at all in equities. So it's going to be that dividend rate, what she earns on it, fairly conservative. So not unlike probably a bond fund. In the future, though, she can surrender paid up additions if she earns them up to her cost basis, and that's going to be tax-free. She can take tax-free loans against the remaining cash values, but she's going to start to be charged loan interest. Now, the loan interest just is accruing on the loan. She doesn't have to pay it out of pocket, but there's a balancing act between how much she can take out in loans and how much needs to stay in the policy, because there always has to be a net positive value of cash value. So if her cash value is $300,000, most of the time insurance companies won't let you take out up to maybe $270,000 in loans. That's a 90% loan ratio. That's where lots of bad things usually start to happen for policies, because the loan interest starts to grow faster than the cash values, and policy gets into a dangerous situation where it's about to lapse. And when it lapses, there's a big taxable event. So remember that taxable event that we talked about, 137,000? If a policy lapses with a big loan, that whole amount comes due. So basically, the taxable part is the same as if there was I always think of it this way, the taxable event is the same as if there was a loan or not. The loan just determines what sort of check she gets. So the basis is unchanged, the gross cash value is unchanged. But if Joe had a policy with a loan and Jenny had a policy with no loan, the taxable event is the same when they surrender. It just depends on what check they get after paying off the loan. So just things to monitor in the future. Could 1035 into an annuity. She's young, fairly high risk tolerance, so annuity could be a tax-free exchange. Her basis carries over. There are low expense variable annuities out there that she could invest in. Right now, she's paying all those costs of insurance for $1 million of life insurance she doesn't really need. A lot of investment options. You as advisors can, even a number of these policies are built for fee-only advisors, can include the cash values as assets under management. But why am I not wild about it, especially at her age? Well, if she takes any money out, withdrawals are considered last in, first out. So all that $137,000 of gains, if she starts taking money out, it comes out of her gains first. And if she needed access to it before age 59 and a half, she's going to pay an additional 10% IRS tax penalty. So you have to take the gains out first. Gains, ordinary income. And at death, let's say she moved it to an annuity and passed away a year later. With life insurance, that goes income tax free. With an annuity, your non-spouse beneficiary, when they are the beneficiary of the annuity, they pay tax on the gains. So once it's in life insurance, unless this is a scenario where once it's in life insurance, moving it to an annuity, many times from these tax, starting to take money and tax out when there's large gains, I'm not a big fan. So what about option number 5, advisory life insurance? In order to keep those good tax benefits, it's got to stay in life insurance. When we move to annuity, we lose some of those. We use a small face amount to minimize those costs of insurance. So instead of a big $1.3 million death benefit, how small can we go? We look at a tax-free 1035 exchange, have many of those same low expense investment options, Vanguard DFA funds, that some of the low load variable annuities have. Cash value can be included in AUM as well. Charge fees on it. Some companies even allow the insurance company to pay the investment advisor fees directly from the policy. So a lot of things have been happening in this world in the last year or two. So with advisory life insurance, there's no 10% IRS penalty on the gains if she takes it out early. Withdrawals are first in, first out. So you can take tax-free withdrawals up to the cost basis first, and then take tax-free loans against the gains. It's life insurance. There should be, those lines should be kind of on the words instead of under. No 10% IRS tax penalty. And at death, the nieces and nephews don't owe any gains. So for whatever reason, my lines are not quite right. No one owes taxes on the gains of a tax-free death benefit with life insurance. So what does this look like now? $306,000 going into the cash value, but it has high immediate cash values, cash surrender values. And you notice I said low insurance expenses. To put that much money in for a female 35, it's got to be kind of a high death benefit. But this particular policy reduces at age 60, or is it 65, and it allows her to start taking out these withdrawals in this income. So just a neat way to have those benefits: tax-free death benefit, tax-free deferral, take withdrawals out first up to the cost basis, then take tax-free loans. So by moving it into keeping in life insurance, but moving into an advisory variable UL, she's 35. We have many years. So for $300,000 to just sort of sit in a kind of an okay-ish bond fund may not be the best move for her long term. So lots of tax benefits, but also investment benefits. With the advisory life insurance policies, advisors have the ability to manage the cash value in AUM. So kind of a win-win for everybody. So we don't always know what the future is going to look like, but like a fortune cookie, try to take a bite, try to enjoy it, and hopefully get a little glimpse into the future. So it's a lot of what we do, what you do, trying to predict what a client's financial plans are going to look like and how much life insurance they need at any point in time and what they might do with it in the future. So thank you to everybody for tuning in. Conferences at the rest of the year. May at NAFA Spring. Jenny, Misha, and Taylor from our office will be attending in San Antonio. And then we'll see many of you at the Garrett Conference later this year, XYPN, NAPFA Fall, ACP, and just all the places where we enjoy seeing you face to face. So if you're new to LLIS, so there's a number of things that we think make us different. One of them is these monthly webinars. So we have 6 more through the rest of the year, and probably one in December that probably Claudia's told me I'm doing, and she needs a topic that I probably haven't given her to her yet. So at least 6 more. And next month we'll be talking about disability insurance with the Greens. We work with fee-only advisors, do our best to save them time and save clients money by doing a lot of what we call pre-underwriting to avoid surprises. So we ask clients a lot of health information, particulars up front when we prepare quotes for them, just to make sure we find the best fit in the areas that we specialize in: life insurance, disability, long-term cares, annuities, and hybrids. We're proud sponsors of a number of different financial planning organizations, working with fee-only advisors, fee-only advising groups to get the word out about how great it is to be a fee-only financial planner and how great an experience clients have working with them. Alice is our online client portal, advisor portal. There's a lot of good information there. So I see that I'm almost out of time. I see a couple numbers or questions that came through, but Claudia, looks like I got most of them. All right, there's one or two that did come through that I'll uh, maybe I'll get back with you. I might have to research the answers on there. And yes, this is all good. Thank you everybody for tuning in. I hope everybody has a great rest of the day, and I will be in touch if there's a couple of these questions that I might have to research. I'll be back in touch by email sometime later this week. Hope everybody has a great rest of the day, and thank you for tuning in.